live recording of the Stacky Benjamin Show. I'm Joe Saul-Sehy, and we'll introduce this pack of gentlemen today. It's all dudes hanging out around the water cooler. So we're going to talk.
Why did you say it like that? Ugh.
What's that?
Why'd you have to say all dudes? All dudes.
All dudes. It is the Welcome to the Dude Show. It's
you know what kind of fest that is.
I wasn't going to say that one, Chris.
Kielbasa.
All right. We are going to get this done because OG has to get out of here, which he made abundantly clear before he was 10 minutes late to our recording session. So, all right, Doug, you ready to go so we can get him out of here?
Noon. I'm on time, baby.
Yes.
All right, let's do it.
3, 2, 1. Live from the basement of the YouTube headquarters, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and here's a question. Buy or rent? One finfluencer, oh God, I just threw up in my mouth a bit saying that word, said he will never own a house again. What's he thinking? We'll debate it with our crack team of financial podcasters and bloggers, and also the 3 people on this episode. But that's not all. Of course, we'll pause halfway through to see who's going to win today's edition of my year-long trivia challenge. And now a guy who loves zero down, but even more loves zero do later. It's Joe Saul-Sehy.
Hey there, Stackers. Happy Friday to you. Welcome back to the Stacky Benjamin Show. Sit back and relax because we're about to have a good time talking about buying versus renting a house. So if you know somebody who thinks that buying a house is a horrible idea, you should never buy a house. Or if you have somebody that says renting is throwing money away, we're going to take both of those sides today. But let's introduce you to the merry band of characters that we have with us. First of all, across the card table from me right now, Mr. OG is barely here, but he's here. He made it. Glad you could join us.
I'm emotionally here. Does that matter?
Emotionally invested in this topic, right?
Indeed.
Buy versus rent, the age-old topic. You've been there. And a guy who, let's see if he's done it both ways as well. Jesse Cramer's here. Jesse, have you done it both ways?
Have I bought and rented? Yes.
Yes.
I have bought and I have rented.
So you have experience galore when it comes to both of those topics,
Yeah,
and
including in some recent markets, by the way, which is a little bit crazy. Sorry, Joe. Keep going.
Well, wait a minute. Buying in a recent market or renting in a recent market?
Sorry, buying and selling in recent markets. It's a wild world out there.
Like buying when you should have sold and sold when you should have bought?
TBD.
Oh, foreshadowing. I love that part of the show. And we don't need any foreshadowing for this guest. He is the man behind the Extreme Money podcast and Heavy Metal Money, and the guy who we could just do ands all day with this dude, because he also leads the Twin Cities, co-leads, I guess, the Twin Cities Stacky Benjamin's meetup group. Chris Luger is here. How are you, man?
Hey, I'm doing well. Thanks for having me, Joe.
Yeah. So let's talk about, first of all, about the Extreme Money Show, which is, as if you couldn't tell by my voice, is written in all heavy metal font because you have to. Tell everybody about what you do.
Yeah, it's the Extreme Personal Finance Show, man. We talk about saving, investing, earning, spending, all turned up to 11.
see, Jesse likes that too, because just like I got the name of his show wrong when he was on, I've known Chris forever, and I managed to mess up the name of your show.
It's all good, man.
See, Jesse, equal opportunity.
Can I tell the story, Joe, of my recent listener who reached out to me?
Please.
So I had a listener reach out to me from New Zealand, wanted to connect via Zoom, just to have a quick chat. We had a really nice chat. And he's like, you know what, Jesse, I do like your new name change, but I also really liked it when it was the better interest.
Which, for people following along at home, it never was.
It never was the better interest. It's just what Joe called it for like 6 months. So the fact that Joe's mistakes are now infiltrating their way out into the real world and making my life harder. Thank you very much, Joe.
And what did I tell you, Jesse? It's what the show should be called. until you decided that, now I'm going to try to get the new name right, but instead having it be the personal finance podcast for long-term investors.
Almost.
Personal
Almost.
finance for long-term investors podcast.
That's it.
There we go.
That's
See,
it.
I'm messing up everything. Let's see if I can mess up the next spot, which is we have a phenomenal show today, buying versus renting. Oh, Chris, we didn't ask. Have you also done it both ways?
You know what? Oh, that's so funny. No, you know what? I have never rented.
Never rented.
Never, because like you mentioned, growing up, renting was throwing away money. Everyone in my family told me so. So I bought my first house at age 20 when I moved out of my dad's place.
Wow. Age 20. All right. Well, we've got Chris here. We've got Jesse here. We got OG here. We got Doug and I. We're going to hear first from a couple sponsors who make sure this goodness is all free. You don't have to pay a dime for it. And then we're going to talk buying versus renting. We're going to talk out of both sides of our mouth, talk both sides of this argument. All right. 3, 2, 1. You know, in this community, I think most people think, Chris, what you said is not true. So I want to start with the case for renting all the time. Let's start with the obvious one in this community. And by the way, if you're brand new to this, people who are finance nerds, they think buying a new car is a trap. They think that owning a home, it can be a money trap. So generally think a lot of things that society in general that you won't hear elsewhere. But then the second half, I'm going to want you to argue the other side. Let's argue where renting is throwing money away. The piece that was the inspiration for this, by the way, comes from James Altucher. In James writes this piece called "Why I'm Never Going to Own a Home Again." So we're going to use his points to kind of walk us through this. You don't need the piece in front of you, stackers, but if you want it, just go to stackingbenjamins.com, today's show notes, and click on the link because we'll have it there for you. James writes, many people have said to me in the past month, I'm going to buy a home, or what do you think of the idea of me buying a home? I like the second batch people. They're my friends, and it seems like they are sincerely asking for my advice, and I'm going to give it to them whether they meant it or not. And he's talking about, I'm going to tell you not to buy a home. So the first one, and let's start with you, Chris. First one he says is your cash is gone. You got to write a big fat check for a down payment, but it's an investment. You say to me, he says it's not an investment. You're out just a bunch of cash for that downstroke. What do you think of that?
Yeah. I used to say that all the time. I used to say it was an investment. It is not. It is not. With maintenance, with not only maintenance, but the taxes, the insurance, all of the stuff that you're going to be paying. I actually did the numbers on my own house, believe it or not. So I've been in this house for 23 years. And the amount I paid for it was about $240 back then. It's now worth about $450. And if you look at all the money I've paid for, after 20 years, I had to get new carpet, new appliances, that type of thing. You add it up, my annual rate of return was like 0.05%.
Wow.
I mean, it's pretty bad. So I don't think of it as an investment. It is not. And let's talk.
Hold on.
Yeah.
Let's talk about just this piece, which is the cash being gone. How much cash did you put toward that down payment?
I put about 20%.
Okay. So what'd you say? It was 220?
240.
240. So you put roughly $48,000 down.
I did, because I sold the previous house and I sold a bunch of stock. Correct.
So if we use this thing called the rule of 72, which is, you take the interest rate you think you're going to get, you divide into 72. It's this mathematical magical equation, tells you how long it's going to take your money to double. Let's say that you would have gotten 8% on your money. Is that fair?
I think that's fair. Yeah.
So 8%. So every 9 years it would have doubled. So I'm just going to, so $48,000 down. You bought it at what age?
Gosh, what was I? I don't know.
How many years ago?
2002. Yeah. 23 years ago. Correct.
Okay. So 23 years ago. So every 9 years it would have doubled.
Yeah.
So it would have doubled 2.5 times
Dude,
roughly,
Don't make me
meaning
sick. You're making me sick to my stomach, Joe.
48,000 becomes 96,000. I got to round this to 100,000 just so I can do this live, but 50 becomes 100, half of another double, $125,000 you would have had versus that money just sitting there.
Oh, Jesse's saying more than that.
Oh, what am I talking about? 150, be 150.
Well, I think you forgot a double, didn't you? It doubles from 48 to 100. That's the first doubling. And then it would have doubled again from 100
then
to
a second one. You're right.
To 200.
50 to 100. Sorry, 100 to 200. And then again,
half your double. Yeah.
That's $300,000. Thank you. Our math whiz, Jesse Cramer, is here, everybody. It's weird that I was a financial planner. Thank you.
But I think also
Thank you very much.
of all the other expenses you've also paid, right? So insurance, think of the insurance, $2,500 a year over that many years is like,
hold on. We're going to read through his list. You're covering all of them, Luger.
Sorry.
Luger's taken that Luger, that gun, and he's using every bullet right here at the beginning. Jesse, the cash gone, does that factor into your decision making?
Did it factor in? It didn't really factor into my personal decision making. I mean, the way I view it, both of them, if we want to look strictly at the financials, I mean, they're both losing propositions at the end of the day. I think you can be charitable, and it's something I did yesterday in preparation for this talk. If you want to make some charitable assumptions, you could say that buying a house is going to come out like you're probably going to lose something like 1 or 2% a year on it. Like if you do some sort of IRR math. I think renting has got to be worse because I'm not sure what the redeeming quality of renting is as far as getting money back. I mean, or if you want to do what you just did there, Joe, and you want to look at opportunity costs, I mean, they both have these massive opportunity costs. But the thing is, right, Chris could have $300,000 more today if he hadn't bought that house in 2002, but you can't live inside of a portfolio, as far as I know, right? You have to have some sort of a roof over your head. But maybe the dangerous part is where some people, they only look at some of the numbers involved and they convince themselves that buying a home actually is a net positive investment, that it is going to grow over time and they're going to be able to pull more out of it than they put in. I think it's kind of hard if you really look at all the numbers involved. I think it's hard to come to that conclusion.
Well, and is that OG, is that kind of a false comparison Altucher's doing when he takes a look at this downstroke and comparing it to an investment? Or is that accurate?
Well, I think the thing that we're missing here is what you're looking at it in a vacuum, obviously. And I think that's what Jesse's saying is like, at the end of the day, it's not, you can't just look at one component of this. There's multiple layers of it. But the piece that you're missing, you're assuming, hey, if I would have kept my 40,000, in our case, our down payment was 100K 10 years ago. And so you could do the same calculation and say, well, you'd have 200 grand today. But my balance sheet didn't change when I put $100,000 into my house versus $100,000 in cash. I moved it from one line item on my balance sheet to another line item on my balance sheet on even the same side of the balance sheet. It was a cash asset, and then it became a real estate asset. And so the question is what happens to that cash, or what happens to that real estate versus the other thing it was in? Now, obviously you could have said, well, you might have invested that 100K, and in 10 years, that money would have doubled. You'd have 200,000.
Well, like we talked about with Chris's house.
Yeah. But what happened to the value of the house? The house that we bought has doubled in value. It's also done that rule of 72. Now we live in a different community than some places, and maybe that's just a short period of time, but I don't look at that 100,000 as wasted. It was just, I didn't consume it. I didn't spend it on Amazon. It just moved on the balance sheet to asset of real estate, and it's grown there. What's the difference?
That is true, Chris. I mean, your money in the house did double once during that period. So it did make some money.
Yeah. I think now that I'm older and maybe wiser, I do think of the opportunity cost.
Growing it faster. Yeah. Well, number two, speaking of costs, closing costs, right? Nobody, OG, thinks about this. I mean, it's funny. The same people that get super analytical about the management fee on a mutual fund, or the 1% fee the advisor charges are like, no, but I love real estate.
Yeah.
I'll pay the 6% realtor fee.
6% commission all day long and 5% closing costs. But advisors are the real crux. Yeah. Yeah. Okay. I mean, this is a cost of doing business. And I think there's a couple of things here. First of all, from a value standpoint, I think that if you have a good, just like anything, it's not a cost, it's an investment when you have professionals on your team. And if you're getting a good value for the check that you're writing for that professional, you'd pay it you'd pay it over and over and over again. If every time you put $10 in a slot machine, you got 11, you would just think about how fast can I put $10 in? You wouldn't say, well, wow, that's ridiculous that it's $10. I'm only getting $1. That's ridiculous. It's like, no, I mean, you're getting something. So if you have got a great relationship and you can, and you can lean on that relationship, and that person frees you time, frees you money, or frees you from making mistakes that you might have made on your own. And only you can be the judge of that, by the way, right? You can't say, well,
Sure.
I might have made that mistake, or I prevented you from potentially making that mistake. You can't prove a negative. But anyways, if you think that you're getting good value for that, then you pay what you pay. But it's a cost. It's definitely a line item. And the same thing with the banking fees associated with the purchase. The banks are going to make money. The title companies are going to make money. The insurance companies are going to make money on that. And I'm probably getting ahead of the game, but then there's all the other stuff that goes into purchasing a house too, like inspections and your time and, all the stuff that kind of wraps around that one line item that you see. My closing costs are $14,000.
Oh yeah. Not even on this list was 75 trips to Home Depot the first week I lived in my,
Well,
every house I've
I mean,
lived
that's
in.
maintenance, right? And I think we've talked about that, and I know Chris has got something there. Who's calling this time, Joe?
It drives me crazy, Chris.
Hey, I sent you some tech support. Didn't you see that?
I know I did.
Just hit the.
I did see it, and I haven't had time to do it. I got to try that. I got to do something anyway.
So Doug, I had a question. I'm sorry, OG, I got a question for you. Or actually just a point. So you mentioned the closing costs and the professionals. I absolutely agree with. Not only are you paying for saving time, but their expertise and how well they can do the negotiation on your behalf. I mean, I'll pay for that every time.
Yeah. That's all part of that. I think some of, again, when you just see the dollar amount, it gets a little frustrating, right?
Mhm.
Because you see, hey, I bought $1 million house and I got an $800,000 mortgage, and my closing costs are $16,000, and you just go, 16. What are you talking? $16,000?
Like what
for what? And then
Mhm.
title insurance is what title insurance costs, and there's stuff in there that's negotiable, obviously. And if you've if you've got a good relationship, hopefully that person will go to bat for you and help negotiate those things down. But remember, these people make money too. You know what I mean? Like there's layers of costs in transactions because of the fact that the person who's sitting at the desk pouring through your box of financial documents
needs to eat.
They've got to put food on the table too, and the bank's got to pay them, and this is how they do it.
You know, what's interesting, Chris, is that, the negotiation piece is the part that I have the biggest problem with, just because I like thinking about how people are paid. Like people talk about commission-based financial planners are going to want you to buy this fund because they get a commission, right? They're going to want you to buy this annuity. And we just got to remember, and again, I think a lot of times we make commission-based people the devil, when I know a bunch of people that work on commission who are phenomenal people and are great at what they do and they do the right thing, but we still got to remember how they get paid. If you're buying a house, your real estate professionals being paid a percentage of the final price.
Mhm.
And so having them negotiate on my behalf, and they don't get paid until the deal's done. Like there have been some real estate professionals I've dealt with that I could clearly feel was just like, yeah, no, we gotta wrap this thing up. And I realized with one professional in particular, I'm thinking of, like, I felt like there was a car payment looming that they needed to make. And it didn't have anything to do with me.
Payment. They need to.
Yeah, exactly. A boat payment, even better. You know, it's funny, Jesse, when it comes to closing cost, James Altucher writes, lawyers, title insurance, moving costs, antidepressant medication. He includes when he looks at that number OG talks about, like, do you remember buying your first house and seeing the closing document and how much this was going to be?
Yeah, I do. It was 2017 when I bought my first little starter home on the western suburbs of Rochester. And yeah, it is always a little disappointing because I think going back to OG's point, you figure to yourself, something I've learned about the real estate industry is that they really do churn, meaning like the attorneys who specialize in real estate closings, the agents, the bankers, the mortgage lenders, like it's kind of all they do, and they're really efficient at here are the documents you need to sign. Here's the way this works. Here's the way that works. And when you see how efficient and quick they are, and then to think that, man, again, going back to OG's example, like for $1 million house, they just slap on a percentage. It's 2%, it's 3%, it's whatever the closing costs are. And you're like, it was $30,000 for how much work? Like 10 hours of work or whatever it may be. Like that's where it is a tough pill to swallow.
I
But
feel like they should be better, Jesse, at telling me what documents I need before 10 minutes before the meeting. I feel like every single property I buy.
We just had a client that was buying a property, and obviously really stressed, big deal, and I said, listen, we need the information 72 hours. Your title agency will give it to you 6 hours. We cannot fund it in 6 hours. Like, it's just not possible for us to get all the transaction stuff done on our side, to verify it, to make sure it's secure. It's just not possible when you drop it in our lap at 4:00 in the afternoon to get you the money by 7 a.m. I'm telling you, it's not possible. That's what they're going to do. So tell them, don't do that to me. Because Josh said he can't help. And sure enough, he called on Tuesday and went, all right, hey, we're ready to close. Here's the number. They said it's going to be about 680,000. I'm like, oh, so we just send an about number via wire? Like, what are you talking about? How do we send about to,
Ish,
give or take, you're good.
Well, you can
Here's
use
the
that little
keys.
tilde button on the keyboard. It's like,
Yeah, just about
that.
ish, round
Schwab
up.
accepts that.
We sent you 700 ish just to round up. You guys are going to send us the money back, right? I mean, and if, he was frustrated, obviously. And to your point, Joe, it's like, surely you could figure this out. I don't know. Call me crazy. 2 days in advance.
yeah.
This is the largest single transaction that anybody usually makes in their entire lifetime. And they're so, and I'm not throwing a bunch of shade here. I'm just saying it feels like they're used to such big numbers all the time that it's like, oh yeah, it's just 681, 722 decimal 41. Just wire that just whenever you can. You're like, I'm wiring $750,000. I'm going to take my time and make sure I don't move the wrong decimal point or send it to the, wrong place.
Right.
So give me a second of breath here to.
That poor woman we had on the show, Shannon, who accidentally sent it to a hacker
and sent the wire money to the wrong place, and
$40,000.
Bye.
Yeah. It amazes me because I'll ask them, OG, point blank, is there any, I know there's going to be stuff you're going to need to last. No, we're good. No, we're good. And then 24 hours before, we are not good. And I'm the one holding up closing if I don't get them the stuff like right now.
Yeah. The loan guy said he needs your most recent pay stub. You're like, really?
You didn't know that like a month ago.
You didn't know that 4 days ago? You just, today's the day you decided you needed it? Okay.
Chris, when you did your calculations, the third thing on James' list is maintenance. So let's go there next. It sounds like this is what dragged down your ROI when you were looking at how well you did with your money by owning this house.
Yeah, I estimated over the 23 years, I probably just repairs and maintenance. It probably was around 35 grand just because after 20 years, I got new appliances. I had a couple times I had to repair like my washing machine. Then also after 20 years, I got all new carpet throughout the entire house. I mean, that was like 13 grand just for that. And then, COVID, I did a bunch of stuff, because I was trapped in my house.
Because that's what everybody did.
I know.
Right.
So I, like you said, 17 trips a day to Home Depot. Like I did a lot of that. So you add all that up, it definitely starts eating in. Where again, if you were renting, something breaks, you just make a call and they come out, they repair it, they replace it, they fix it. Where, It's my water heater goes out. I need to get a new water heater, right?
I feel like besides having all this money for the downstroke that I don't need, I get to keep that and I get to deploy it elsewhere, Jesse. I really feel like this is the place where renting might win biggest, because when anything goes wrong, when you were renting, I bet you just made one phone call and said, "Hey, landlord, send somebody over because the dishwasher's broken."
I mean, that's fair, but I'm gonna throw a little a wrench in the system here, because if renting truly was this miracle, where you are benefiting from renting, right? Like you're gaining money from renting. It's net positive for you as the renter. Clearly, we would have a bunch of really poor, failing landlords out there who weren't making a dime. Being a landlord might as well be a charity, right? Because you're just giving your money away to the renter. Well, okay. I'm being facetious here. Being a landlord, I mean, someone's being pretty successful at being a landlord, hence all the rental properties we see out there in the world. And as far as I can tell, unless there's someone else involved, it's a zero-sum game. And every dollar that the landlord profits would be a dollar that the renter is not benefiting from. Okay, my point is, yeah, I'm sure the maintenance specifically, it is better being a renter than being a homeowner. Like from my experience, no doubt about it. But still, I just go back to this
Well,
idea
great.
that. Go ahead, Joe.
Well, just like one of the biggest mouths in social media, Grant Cardone,
Yeah.
drives a hard wedge in the middle of what you're saying there, Jesse. He's like, owning a property that you live in is a waste of money. Renting to somebody else is a phenomenal use of money. He's got those as two totally different realms. In fact, I think Cardone and his family even rent uh, a, a place while they looking at some of these high end things that they show on social media. He even rents. So, I mean, he's talking specifically about a house that you live in, Jesse.
Yeah, I mean, I guess show me the math, right? What's the phrase? I can't think of
Show
it
me the
now.
money.
Yeah, it's like, uh, there's some phrase out there about like, in God we trust, but all else bring data. I think that's what it is. So bring the data. Show me the numbers, Grant Cardone, that shows it. Because I'm just trying to wrap my head around it. It just on its face, it doesn't make sense. It doesn't make sense. If Grant Cardone was living in the same exact place he's living in now, but he was owning it, he would be making a worse financial decision than if someone else is owning it. Well, that means that someone else, therefore, is losing in their current setup. And in a capitalist society, that doesn't make sense that landlords would consistently and constantly be losing, because no one would do it then. It just doesn't
Well,
make sense.
I think that Jesse, the difference is that being a landlord is profitable, right? Being an owner of your own house is not profitable. You're not the opposite of a landlord.
Because there's no income.
Yeah,
No,
there's
but
you're missing the income part of it.
no,
You're saying
how can a landlord be profitable though, unless the tenant is unprofitable?
I don't think one
I'm-
has to win, the other has to lose.
yeah.
How is that
No,
possible
I
in a
think that
zero-sum game?
Jesse, I see what you're saying. I think here's the differentiator for me. I talked about on Monday's show about how we just started this construction project. This construction project, everybody that knows what the construction project is, know that this is financially stupid. This is absolutely stupid. If I own this as a property to rent out to somebody else, I would not do this because the ROI is horrible. But I'm not moving again. And I'm not doing it for a profit motive. I'm doing it because I work from home. I live in this house. I want to be in this badass space that we're building out behind our house. But when you look at what it's going to cost, I think it's because homeowners do things that are not great with the property when it comes to resale value, or they make emotional decisions, not ROI based decisions. I think that's where homeowners lose the zero sum game. But to your point, it's not because renting is a miracle. Like, it's fantastic.
Well, yeah, I mean, I guess just to expand on your example there, Joe, you're right. So if I'm a homeowner, I get to choose to do things in my house that might be dumb financially, right?
Yeah,
You're
that's
absolutely
coming.
right.
That's coming in the second half of this because I do think
Okay.
that's an upside of owning.
But if I'm a tenant, what you're saying there is, well, I don't get to choose if I do the dumb thing with my money. My landlord gets to choose if they're going to do the dumb thing with their money. And my argument is, well, if there's something that you want that's really nice to be done to your rental that you're renting out as a tenant, and you go to your landlord and you're like, hey, can you please put a marble fountain in my kitchen? It's what I've always wanted. That landlord is going to say no. Like, my point is, the landlord is not going to do stupid things with their money so that you as the tenant benefit and that they as a landlord lose out on that.
But does
Therefore,
that but does that make
yeah.
it better off for you then too as the tenant because you didn't do something stupid with that money?
Well, what it means is
You
that
would
you're
have
not
more
getting
efficient use of money.
right. You're not getting capital improvements to your living space that you
Sure.
want. That's what it means, I think.
Well, next on this list is taxes, right? You don't have to pay any of the property taxes, the holding taxes. You've said this before, OG, you don't really own your house, even when you pay off the mortgage.
Yeah.
Miss a few tax payments. We'll see who actually owns that property.
Yeah, and different municipalities have different rules for, senior citizens and that sort of thing.
For squatting
For
after you don't pay the property
also
taxes.
that. Yeah, that's profound. If you yeah, I don't know that gets a little too political. You squat in a rental and it takes you 5 years to get kicked out, but you don't pay your property taxes and they'll be there on Tuesday. But but no, I mean, you have property taxes and you have insurance that you don't have to have insurance if you don't own any money on the house, but there's an ongoing cash flow responsibility. I think that one of the big misses that people have in that calculation of, buying versus renting is they just purely look at the rent expense versus the mortgage, or maybe they look at the rent expense versus the mortgage and taxes and insurance, and they go, oh, well, this is dumb. My rent payment's $2,000 a month. My mortgage payment would be $1,950. This is a great deal. Like I'm gaining equity on this, forgetting the fact that insurance goes up every year, property taxes go up every year, and to kind of put a footnote on the maintenance costs. I think that the average maintenance cost, if you're keeping up with your home, is roughly 1% of the house value. I think every year, if your house is worth $500K, I bet that you're putting $5,000 a year on average into that place just to, keep it up the way that you need to keep it up. Whether it's like a big expense, like Chris is talking about, like, hey, every so often we put new carpet in because that's what we, it's wore out and the kids are gone, and now I want to, have some better utility, or if it's required maintenance like AC repair, or water line breaks or something like that. But I bet if you added it up, Chris, you were saying 35K over the, you're not counting stain for the fence, or or the like you said, the one-off trip to Home Depot where you had to get a wrench to fix the whatever. It's
Thing for the stuff.
It's the things with all the stuff. Our refrigerator just started making a weird noise. Like, we can't even figure out what the noise is for.
Again?
When you get water out of the water thing, it just goes. Like,
this is an ongoing multi-year saga.
This is the appliance we hear about more than any other thing in OG's house.
What are you talking
damn
about?
Refrigerator.
My refrigerator's fine. I think you're confusing me with somebody else.
No, you had this problem, what, a year, 18 months ago, maybe? I don't know.
Well, there was should we just buy a new condenser or should I buy a new refrigerator? Anyway.
Let's get to the last two on this list because I really want to argue the other side because I feel like Jesse's already kind of headed in that direction. Number E, looking at what is E? A, B, C, D, number 5, I guess that would be. James writes, you're trapped, which means that if you decide to move, I had this happen. I became a landlord inadvertently because we were moving to Texarkana, and the market in Detroit got so bad, I was trapped in that house. Like, I wasn't gonna be able to get rid of that house. So you are trapped when you own the property. And then the last one on his list is, he says, ugly. All of the ugliest types of investments. It's a liquid, it's high leverage, there's no diversification. And well, those are the 3 big ones as I scroll up. And no diversification. It need to be a little bit more definitive. I think we all grasp those. It'll be interesting to see the other side of this, though. Let's do the positive side for owning a house here in a second, why you should own a house. We're going to do that in just a moment. But at the halfway point of every Friday show, we have this phenomenal year-long competition between our 3 frequent contributors. And Chris Luger, you're going to be playing for Team Paula Pant today, which is amazing because Paula's on a 2-game win streak, which, by the way, corresponds with the fact, Doug, that Paula Pant has not been here the last 2 weeks. She seems to be winning by not being here. So no pressure, Chris, but she seems to be winning with her surrogates like you. So, but do you want the good news or the bad news about how this is going to go?
I always take the bad news first.
Well, the bad news is that you are still tied for last, right, Doug?
Yes. You are of the people in second place, you're the closest to third place.
Because you were third place last year. Yeah. So what is the score, Doug?
The score, Joe, is 3-2-1. Joe, the score is Paula most recently achieving a tie at 3.5 points. That just happened last week. Jesse also has 3.5 points. By the way, the half point for those of you who were not with us maybe a month ago was somehow negotiated by Jesse and Paula, who wanted to split a point. Wow. So somehow they
wanted to trade it for a player to be named later, which we didn't allow to happen. Like
real estate agents can split a commission, but we can't split a point. What's this?
The most I would grant them was a half point each. So Jesse and Paul are now tied for last place at 3.5 points, just 1.5 points behind OG, who has 5 points.
One of these two people, though, Doug, is going to get within half a point if they stop OG from becoming a freight train again, like he was at the beginning of the year. So, Chris, those are the stakes.
I was told to make it competitive.
Well, you got to throw a couple games. The Chicago Black Sox scandal on Stacking Benjamins. All right. We know what the stakes are. Doug, you've got the trivia. What are we talking about this week?
I would love to share the trivia with everybody, Joe. Hey there, stackers. I'm Joe's mom's neighbor, Doug. I've been digging in and reading about great marketing lately. I love a win-win scenario, so I've been thinking out of the box about value-added solutions for this podcast. I'm going to ramp things up and really, think out of the box, get everybody in a circle. I'm just picking up all these great phrases. One book says that the customer should be Luke Skywalker and the brand should be Yoda. Well, that makes sense. Here in Mom's Basement, we like thinking of our stackers as Luke Skywalker, or heck, even Rey Skywalker now, right? So I guess that would make us Yoda then, I guess. I know Joe's pretty old, but Yoda's even older. How much older? Not that much. Here's today's question. How old is Yoda in the Star Wars movies? I'll be back right after I go draw up a diagram to explain to Jesse who Yoda is. It's going to take a while.
Jesse was quoting Star Wars, I think, the first week you were on this show.
Yeah, but he's young. He's into the new Star Wars. You got to go to
which movie are we talking about here? There's a long saga. The timeline of Star Wars, of the movies that's out, it's kind of long.
Well, we've got, I believe this is from the first one, A New Hope. We'll go with his age in A New Hope.
Cool.
So, all right. That means, OG, you're going first. The Star Wars movies, to Jesse's point, have made a ton of Benjamins, ton of money. How old is Yoda?
I mean, how old was he when he died? Is that what you mean?
Spoiler
alert.
If you're saying spoiler alert on a 50-year-old movie or 40-year-old movie, do you think it might be your problem, not ours?
Yes. So I'm going to say that Yoda, I feel like I should know this. I'm going to say he was 965.
965. And you just pulled that out. Just
that sounds
rando.
Like nailed that right on the money.
Like 1,000. Like, no, like you're thinking he's no, I don't know if you're right or wrong. What I'm saying is What I'm saying is usually, Doug, he's got like a 85-minute explanation.
No, I was literally, as he was talking about it, the only thing that I thought in my head was, I remember there's some old people in the Bible, and for some reason in my mind, I was thinking that they had some sort of connection to that. Like they used that same time frame as the oldest Bible person. I don't know why I thought that.
The fact that you didn't point that out to us in glaring detail.
Well, you just asked for it. Time is
It
money. So.
It also shows how badly he wants to get on the road as soon as we're done recording. Just give me 965.
Yeah, put me down for 965.
Yeah. All right, Jesse, he's got 965 long years old. How about you?
I was a little disappointed when OG said that, because I'm pretty sure somewhere in the recesses of my brain, I mean, I grew up on Star Wars, right? I thought Yoda was in like the upper 800s. So to hear OG say 965, I was a little bit bummed, because that's it's gonna make my guessing a little bit harder. But still, I'm gonna guess 850.
850.
Yeah.
Boy, they're all those darts are kind of close together, Chris. What if he was 26?
And just didn't put his nightly his cream on at night.
Yoda years.
They're gonna. I mean, I have friends that are really good. They're gonna take away my geek cred card because I know I'm gonna get this wrong. But in my head, when you asked the question, in my head it was 928. I know that's really close, but I'm saying 928.
You're going right in between these two dorks. 928. We always told Paula, don't trust your gut. We've always said that. So
Grogu was only like 50.
Was only what? Really?
Grogu was only 50 years old.
Yeah. No, really?
Yeah.
Really? In he's talking about Mandalorian for people that don't know what the hell we're talking about. Yeah, Doug's got no idea.
I have no clue who.
What? Oh my God, Doug!
Fantastic series, and I can't wait to watch Andor. I'm so excited about the new season coming.
I tried twice to get into it. I just could not do it, Joe.
Oh, I agree with JD Roth on this one. It's the best one of all.
Okay, different podcast. You're on the wrong podcast.
All right.
Sorry.
All right, who's going to win this thing? We're going to let you know in just a minute. 3, 2, 1. OG, you kicked off this love fest with just shy of 1,000 that everybody seems to be gathered around with 965. How you feeling?
I feel pretty good. Yeah. I mean, I'm in the ballpark.
Apparently, because Jesse thinks you are. Jesse, 850. Chris came over top of you, 928. You feeling good?
I'm feeling good. I think, by my math, I'm kind of doing it right now. What if it's like 890 or lower? I think it's me, and if it's 890 or above, it's Chris. Because I was gonna say, like, I still think he was somewhere in the upper 800s. If my trivia memory is right.
Chris, so you've got a small window there in the middle by kicking the field goal. You feeling good at all?
You know what? I am.
You are feeling good. All right. Everybody feels confident. One of these three, Doug, are going to be, I guess, proven correct. 2 of the 3 are going home empty. Who's winning?
Hey there, stackers. I'm basement-based marketing thought leader and guy who's been told he's got a great lightsaber, Joe's mom's neighbor, Doug. Did you hear about what Yoda said the first time he saw Star Wars in 4K? HDMI. What about the time Joe asked him what his favorite dinosaur is? No. And Yoda answered, Doceratops. Because there is no try, Joe. There's only do. There's only Doceratops.
Please, God, give us an answer. So make it end. Now I know how people feel when I go on with the dad jokes.
So how old is Yoda? Well, I'll tell you that Darth Vader's offspring OG was off by 65. My nemesis Jesse was off by 50. Chris/Paula only off by 28 because the correct answer is 900, meaning Paula is now got sole possession of second place.
Unbelievable. Jesse, your gut instinct right on.
more importantly, Chris gets to remain a nerd with all of his buddies.
I know, right?
You don't think I'm a nerd? Go listen to that episode of Stacking Benjamins. Fast forward through all the important buy versus rent stuff and just listen to how I did on the trivia. Nice job, Mr. Luger.
Thank you.
It's fabulous. And OG, your instinct was correct. And yes, that was me going, how the hell do you get that close with your first guess? I should have disguised that maybe slightly better.
Yeah.
It's like, really?
I thought I hit it right on the number based on that response.
Yeah,
That's
you were
pretty good.
You were so close. I'm like, nobody's going to get that he's 900 years old. And then Jesse's like, I think it's high, like 890s. I'm like, oh my God.
I would have been Paula if I were playing. Because I'm just not a sci-fi guy. I would have no idea. I would have said he was like 74.
Luckily, based on Paula's results lately, we're going to tell her this, and she's never coming back.
Right.
I mean,
I do better when I'm not here.
Any movies, right?
She doesn't. Well, she joined a theater now where she goes and watches like one a month.
Okay.
That is her. Yeah, she's turned over a new leaf.
But she's got like 40 years of catch up to do.
She's got so much catch up. Imagine if you hadn't seen movies until just lately. What a cornucopia.
Dude, so this is true story. I was out on a date the other day. It does happen.
You were on a date. That's a true story?
Yeah, yeah. And I asked, I said, hey, what's a movie that you could watch over and over again? Like, what's one of your favorite movies? And she said, why would I ever watch a movie twice? And I was like, thank you for the time. I got to go.
Yeah. And scene.
I mean, what?
We are not a match.
Yeah.
Yes. Say we're not a match without telling me we're not a match. That's fantastic. Hopefully that was right at the beginning. Was that like question one?
It was.
Oh God.
It was a very odd conversation after that.
Check, please.
Just a great night. Let's go into the other side of this argument. Jesse, this is the other side. You know, renting is throwing money away. Let's buy a house. What's the pro side you never hear in the financial community about the upside of let's buy the property?
Well, you kind of have full discretion over anything you want to do. I guess, going back to the numbers, if we want to stick to the numbers, I still want to see someone show me that buying a house really is going to be throwing more money away. I kind of have a hard time believing that based on all the number crunching that I've done, but I'm open-minded to it. And then there's, again, maybe I'm now a bit more of a family guy than I was, say, 5 years ago. But I think the idea of raising your family in one place that you get to call your own, in one neighborhood, et cetera, et cetera, et cetera, one school district, whatever it may be, it kind of gives your family a sense of home that I think has a really nice intrinsic value to it. So the list goes on from there, but that's where I'll start.
It's funny. I was just thinking while you were talking, when you said, I want somebody to show me the chart, and I realized that I just saw one. But what I also realized, Jesse, was that the chart kind of points out something that you pointed out in the first half of the show. By the way, it points it out the wrong way. It points it out a way that looks like it's apples to apples, and it's not. Jeremy Schneider, Personal Finance Club. I generally like his charts, but I do find some of them misleading. I find some of them just, frankly, Jeremy, I find some of your charts misleading. And one of them is he had a chart talking about this, that if all of the things are equal, but you know, the expenses out of pocket to buy the monthly expenses to buy a house versus the monthly expense to rent. So you make the rent equal your mortgage payment. He said, you still have all of these other costs on top of it. Right? If you're a homeowner, you've got property tax, you've got homeowners insurance, you've got your own maintenance costs, you've got all this other stuff that we talked about in the first half of today's show. But I just realized while you were talking, Jesse, how that is wrong. Because if it was apples to apples, your point earlier on is the landlord has no upside.
Correct.
The upside is those numbers are not going to be the same because the landlord needs to make some money. So you're going to be living in a crappier house if you rent than if you had the mortgage payment for the same amount of money. Does that track?
Yeah, no, that's correct. And I think I was while you were talking, I was searching for Jeremy's post, rent versus mortgage. Your rent is the most you'll pay, your mortgage is the least you'll pay. And then he shows these extra fees, and he kind of shows the rent and the mortgage being equal.
Yeah, he
but
shows
then
them
there's
as
these
equal, which
right,
is
right.
is to your point not going to be, because if you actually put the two houses next to each other, there's no way in hell you're going to rent the house for the amount that you would have for that mortgage payment.
Well, I think
Correct.
that
And there's
from
also
a from
equity involved too. So go ahead, OG.
yeah,
There's
I was
also,
just
I mean,
no, I was just gonna say from a landlord standpoint, we had two rentals for a while, multifamily, and it was very clear to me when I bought this place that the previous owners used all of the available cash flow for themselves. Like it was very clear. They were like, every dollar we can wring out of this, we are taking, because you could tell they were not interested in upkeep. They were not interested in maintenance. They were not interested.
They were
in
saving that for
landscaping.
you.
They were, well, where they saved it for me was the value of the property was was commensurate. There we go. It was also commiserating. I was commiserating a lot on that property. Was commensurate with what was going on in both the rent income and profits, and then also the status of the building. And so when we went in and bought it, I was very clear that I was not interested in the cash flow of it. If it broke even, that would be great. If it made money, I was interested in taking all the available cash flow to buy the equity side of it, if that made sense. And so this guy bought the property at $750K, sold it to me at 300. I have no idea how much cash he took out of it, but he owned it for 20 years. I bought it for 300, lost my what on it for 2 years in terms of cash flow. I was upside down 40K a year for 2 years, sold it for 750 because we rehabbed apartments and we improved the landscaping and we resurfaced the parking lot and we did the roof, and like we did the stuff that made it beneficial on the equity side of it. So I don't know that it's exactly fair, and maybe this helps you, Jesse, or helps your point, or it doesn't help your point. But when you think about the landlord, like they have to make money, you make money different ways. It doesn't always have to be break even cash flow wise. I was very comfortable with losing money, $80,000 over this short 2-year period, because I knew that whenever I sold it, that's when I got my payday. And so you're never going to find an apples to apples comparison on this, because if you start with the concept of housing cost, right? Like cost for dwelling, you know what I mean? Like you can always say, well, if you bought it, you would want to have a little bit nicer place, or maybe you'd want to live in a different neighborhood, or you would never buy a 2-story. You would only buy a single story, but you're happy to rent it. You know what I mean? Like there's no way to compare, what this guy is trying to decide on, or, what the article's about. It's so personal. It's ridiculous.
Well, but I think we can draw a few truisms. And one is the longer you stay in a house, the more renting makes less sense.
Mm-hmm.
And
if the equity value of the house goes up.
Absolutely.
The first house that okay. So here's another personal example. Our first house that we bought a 4-bedroom colonial because we had 0 kids. And it made a bunch of sense to have 3,000 square feet.
You had to have all those bedrooms, right?
Had to have all those bedrooms. And we had no kids for five of the 10 years we lived there. We had no kids. We sold the house for the same price we purchased it for 10 years later. The terms that we had on the mortgage was interest only. So we paid effectively a rent payment to the bank for 10 years. We had a little bit of principal on the mortgage because we had a primary mortgage and then a HELOC separately. So the HELOC was actually we were making a dent on the HELOC, not the primary. How effed up is that?
So weird.
Yeah.
So weird.
Anyways, the long and the short of it was 10 years later, we walked out of there with $7,000 in our pocket, barely enough to afford Stevens to pack our stuff and ship it to Dallas. After 10 years of those payments. Now, you could have said in that example, well, dude, if you'd have just rented a place, you'd have come out way ahead. Well, yeah, but if I was going to rent a place, I would have rented a 2-bedroom apartment, not a 4-bedroom house. And to your point earlier, Joe, maybe it would have prevented me from doing the dumb thing of buying a freaking big giant house that I couldn't afford
with all that money.
with, with no money down and interest only and, whatever, all that other sort of mistake. So, again, I just come back to, it's hard to make a apples to apples comparison here because you're trying to prove that you would make the same decisions given two different sets of circumstances.
Well, and let's talk about that too. Chris, you talked about how your money didn't grow all that quickly, your rate of return pretty low. But we look at these things and we go, if I would have only had an index fund. Well, let's do that. When you actually look at the numbers of people that own index funds and you look at their returns, which company did that? OG Fidelity went and looked like at their people. Was it Schwab? One of the big companies went and looked at their average investor. The average investor makes enough dumb decisions with their investment that the primary property, the fact that you have this trapped equity in there, for a lot of people, and they say, my house is my retirement, right? You heard that a lot from older people. My house, that's where all my equity, that's my, I don't need a 401k. I got my house. Well, that may be a little more true than we think it is for the average person and how poor we are at actually investing. The forced saving for some middle America is actually a good thing.
I think for those people that are doing very little to save for retirement, it is something that they're counting on for sure. I think that I think the argument of why someone would own or buy a property, I think there's just something to be said about having a paid off home, owning it, a place you can call your own, and I can do as many stupid decisions as I want, right? I can knock holes in the walls. I can run Cat 5 cable throughout every nook and cranny. I can do the things that I want to do and I don't care. I don't have to ask permission. There's just something to be said about that.
Is that a 1980s video game behind you?
It is.
I was just looking at that.
I think that I cycle through that. I think that's a Sega Genesis. I have a classic NES as well, but
dude, your nerd card is safe. Don't worry about it, man.
I was like, great points, Chris. Is that a video game? Glad you made those points. Jesse, anything else in the one for buying category?
Well, I thought when Chris was just talking right there, a thought popped into my head, Joe, and maybe this doesn't exactly answer your question, but
well, it does answer my question. Thoughts do pop into your head from time to time.
So that's the eternal question. What's
we know
that
it's
hollow
true.
sound? Oh, Jesse's knocking on his forehead. So what do we call a market when there's millions and millions of participants buying and selling? Everyone's looking out for their own best interest, and they, through their own, supply and demand and their own choices, they find an agreed upon price. What do we call a market that behaves that way?
Open market.
Yeah. Oh, that's a good answer. That's a fair
efficient.
answer. I was going to say efficient. That's what I was going to say, Doug. And so part of this whole argument today, or anytime someone comes forward and they're like, no, it is absolutely renting, or like, no, it is absolutely buying. That's the smartest thing to do with your money. What they're saying, in essence, is that like the market's not quite efficient and that their argument has to be the better one. And so this thought kind of popped into my mind that it's like, considering that you have here in the US, you have hundreds of millions of people who are making their living decision on where to live and what to pay and all that kind of thing. To think that that market isn't at least somewhat efficient in finding the right price, or that, in other words, that like that market isn't somewhat efficient at balancing the scales between renting and buying. I gotta think there's some of that probably going on behind the scenes, that if we really did look at the numbers, we might be surprised to see they're more even than we think.
I get that part of your thinking, but OG, don't you think he's talking more about rental real estate than real estate that
No, I mean, from a big macro standpoint, I would agree with that. I mean, if renting, if there's a lot of rental properties being built that are not supported by market demand, then what's going to happen? The rent prices are going to go down. And then someone new that moves to the community is going to say, what do I do? I need housing. I need to find some housing. What should I do? Should I go buy a house or rent one? And they'll look around and they'll say, well, renting is so much less expensive because of this inefficiency that has now materialized, that it makes more sense for me to. I mean, you can see that's going on in little micro communities across the country. We live here in Texas, Joe. So, in Austin's a great example. Tons of people moved in. They built a ton of multifamily housing and a ton of single family housing. And now people went, oh, it's hot in Texas. Maybe it's not as cool as we thought in Austin. And so now there's a little bit of an exit from, I don't think probably net, but maybe. In any event, I'm reading the articles on this of like,
Sure.
there's a little bit too much housing. There's a little bit, it's too overbuilt. That's what they'll say, right? Built a little too much.
Built quickly.
And so that's going to manifest itself in lower housing prices or lower rental prices. And then to Jesse's point, an educated consumer with all the facts will make the most efficient decision for them in those circumstances. I mean, if the material required to build your deck tomorrow was 5 times as much as what you thought, are you still building it? Or would you say, I should wait. I should do something different now that I have that information. Maybe I'll use a different material. Maybe we'll make the plans a little smaller. You know what I mean? Like you will do something new with new information, with a radical change. So I can get behind Jesse.
I do think a lot of people behaviorally, when you think about, I only rent this place, you're not going to make some of the behavioral moves to spend money on things that you would spend it on if you own the place.
From a big picture, like I think Jesse's point maybe is from a bigger picture. If you just think of the word housing, I need shelter.
Yes.
I'm going to make an efficient decision based on the facts that are at hand. And if there's such a disparity between one or the other, then it will gravitate to that. It will change the pricing of that back to more of an equilibrium. And then it becomes a personal choice versus wildly radical financial one.
I think that's a great place to leave it, because what you
left it on my topic.
Because I think it is what you do with the money, what you do with the decision that you made, right? If you make a decision to purchase a house and you're only going to live there 3 years, or you're going to put a, expensive thing on the back of your house like I am, well, then so be it. That's going to influence what you do with the rest of your money. It's that opportunity cost that we were talking about, and forced savings. And I think it's great, Chris, that you did the ROI behind that decision, kind of as a cautionary tale, but I don't know that it ended up badly. I think you like where you live.
I do. And I think that, the fact, I mean, you mentioned too, Jesse, about having a place to raise your kids, a community, a neighborhood, the friends they grew up with. I wasn't going to move anytime soon. And yeah, I do.
Well, let's find out what each of you are doing. OG, we mentioned that you're out of here right after this. Any big plans this weekend?
Is this next Friday?
This is next Friday. Yes.
Yes. Huge plans. So a little bit after school activity Saturday morning, and then a very, very important husband-wife golf tournament, affectionately known as the Divorce Open.
I was just going to say.
Because when you play alternate shot with your bride, invariably one of you, and I'm not going to say who, I'm not going to point fingers, but one of you leaves the other person a 2-foot putt for par, and the other person leaves them a 7-foot for bogey. And you just go, how is that possible? And I don't want to throw someone's putter into the lake, because that doesn't make any sense. But no, it'll be fun. We have no expectations this year. We're going to have some fun with it. And then Mrs. OG's birthday's on Monday.
Oh,
Cinco de
awesome.
Mayo. She's got somewhat of a milestone-ish birthday in her mind.
She gets a big party every year on her birthday.
Every year, the entire southern half of America celebrates for her. That's great.
I haven't made sure when I was in Detroit, I celebrated. Yeah. A lot of the world celebrating that day. That's fantastic. Let's have our guest of honor go last. Jesse, what's happening at the Personal Finance for Long-Term Investors podcast, better known as the Better Interest Show?
Well, I think we'll see. You know, as we're talking, there's still a week left or so in April, but I'm pretty sure April is going to be our best month of all time, which is an exciting thing. We're about to release an episode with Bill Yount from Catching Up to Fi, and then following up from that is going to be, I think, an AMA episode, and then we're gonna have Don from what's Don's last name, Joe? Don just joined us here on Stacking Benjamins.
Don from the Don.
Don. Not the Mafia Don. We're talking Don McDonald. Don McDonald. Very excited to have Don
from
McDonald
Talking Real Money.
Talking Real Money. Exactly right.
That's
so fun things happening over at.
You're not talking about Don. You're talking about Don.
Correct. Amazing radio voice.
Oh my
Amazing.
God. Just incredible. And see, he makes it about him every time, Jesse. Every time. Doug's like, don't forget, there's somebody else with a radio voice. Chris Luger, thanks for hanging out with us again, brother.
Oh, thank you so much for having me. This was fun.
So what's happening at the Extreme Finance Better Interest podcast?
The Extreme Personal Finance Show.
That too.
Yeah. We got some great episodes coming up. I got one coming up talking about, is real estate investing right for everyone? How some people think, they don't want anything to do with real estate investing at all. So we're going to talk about the pros and cons of there. We're also got an episode coming up talking about how to prioritize your passions and purpose in life, especially after you've reached FI. So how do you do that when there's so many other things that you want to do? So yeah, a lot of fun stuff. You can find out everything over at heavymetal.money.
Watching all kinds of movies with people who are not that date.
That's right.
Yeah. Great times, everybody. If you've hung out with us live on YouTube, thanks a ton. If you want to hang out with us live on YouTube, we're normally here Wednesday afternoons. We're recording at a weird time today because of our schedules. But if you want to hang out on a Wednesday afternoon, come join us. Please, if you know somebody that needs to listen to this because they haven't truly thought through the buy versus rent thing, give them the name of the podcast, pass this along to somebody that needs to hear it. Otherwise, give us a review and Doug will read those on the show on our Crazy Monday Wednesday shows.
As long as they mention me in the review. Those are the ones I read.
That's the only thing. All right. That's going to do it for today. Doug, what's the 3 things we should have on our to-do list at the end of today?
Well, Joe, first, take some advice from Chris. He says it's better to be a renter because if you're a homeowner, you got to make sure the carpet matches the drapes. Did I get that? Did I get that right, Chris? I think I nailed it.
No, I think what I said was that I can't think of anything. I can't remember what I said because that was pretty funny. I totally got distracted. That was pretty good.
Second,
this is the best to-do list ever already. Okay, number 1, I don't know.
Yeah. So basically, I nailed it.
You nailed
it. Jesse said you need to own a home so you can be like Family Guy. Jesse, would you say you're more like Peter or Stewie or maybe Lois?
I thought for sure you were going to make a comment about the carpet in Joe's mom's basement.
No.
That was a good one.
Oh my.
Look at the time.
Wow, we got to finish this up. What's the big lesson, Doug?
About the big brother. I can't even talk after that. Okay, 3, 2, 1. But the big lesson, buying versus renting, don't overthink it. I guarantee you there's a corner in your neighbor's basement they never look in. And that is where you put your blow-up mattress. Problem solved.
Thank God you said mattress.
Mattress, yeah.
Thanks to Chris Luger for joining us today. You'll find the Extreme Personal Finance Show wherever you're listening to us right now. We'll also include links in our show notes at stackingbenjamins.com. Thanks also to Jesse Cramer for hanging out with us today. You'll hear the latest episodes of the Personal Finance Show for long-term investors wherever. I'm sorry, I'm out of breath. Wherever you're listening to us right now. Is there an acronym we can use for that show title or something? Thanks also to OG for joining us today. Looking for good financial planning help? Head to stackingbenjamins.com/OG for his calendar.
Bam. All right. We got to go, everybody. We'll see you next time.
Thank you.
All right.
everyone.
Hold on a
See you
second,
guys.
Chris.
Oh,
Yep.